Welcome to the daily update, where I'll go over the action in the market for Monday, May 6th, and then we'll see how things look for Tuesday, May 7th. We're looking positive now. It was on an increase of below average volume, so we want to be aware of that. But things are seeing a lot more confirmation of turning back more positive now. So we can just kind of go with that. We were leaning more towards the negative side, even though things were improving quite a bit. But now we're seeing more confirmation on the positive side. But as always, there are things that we need to be aware of. So let's go back and talk about what happened. We did have a gap higher open at R1. That was at 51.44. We went up and hit R2, which acted as resistance earlier in the day. That was at 51.61. Then we just chopped along R2. We didn't see a lot of selling into strength. We just kind of drifted. But then later in the day, we started to climb up above R2, and we ended up closing at the high on the day. We were up 1.03% on below average volume. So that is a bit of a concern when we see an upward move. Some folks really don't count volume as being all that important. I do. So it's just, you look at it like the price is the ultimate indicator that we have to follow, whether it's going up or down, no matter what the volume is. But at the same time, volume gives you an idea of the velocity, the conviction behind a move. So we are now positive in the short, intermediate, and long term. Can we hang on to that? There are some things that we need to be aware of here. The market seems to be, for right now anyway, thinking that inflation and interest rates are more friendly. It kind of goes back to last Friday with the unemployment report, or the employment situation report, coming in weaker than expected. There was a fear starting to build that if the employment situation was really strong, that was going to feed into more of this inflation type of a thing. Now, folks, you hear the word stagflation being thrown around quite a bit. Yeah, we could develop into that. And when I go through one specific chart in the weekly video, I talk about that we're in a declining inflation environment for the most part right now. It could be starting to turn and go back up. But then what happened after that, when we compare it to earlier times, is we saw a massive rise in inflationary indications. And then that led to a thing called stagflation, where you have little to no economic growth, but really high inflation at the same time. Is that going to happen? We don't know. And to be real dogmatic about it, we can't really take a stance at this point. We just are aware of it, and we'll watch things and keep an eye on it, and then just evaluate them as they play out. We're also dealing with a lot of earnings reports that will be coming out. We didn't have any economic reports in Monday's session, so that didn't really give the market much to key off that way. The geopolitical events for right now, not really having an impact on the market. So some comments. It was a broad-based advance that we saw in Monday's session, and the mega caps held up well. They did a little bit better, and that's really what's been giving some support to the market. But to see it across the market was more encouraging. We already have a list of extreme positive, or you could say overbought indications. Now, as I always say, there's two ways to look at this. One is that we've gone up too far too fast. That would be an overbought condition, and we're due for a pullback. Another one is we're seeing a lot of confirmation that we have gone up quickly in the short term, but that could also suggest good momentum. So there's a positive side and a negative side. Right now, we have the Stochk RSI, the Williams percent R, both of our CCI charts, the 14 and 20 are now on the list, and the stochastics. In the long term, we're still looking extreme. Again, there's two ways to look at that with our 150 and 200 period simple moving averages. Are they extreme positive or just showing good momentum? The scenario, I haven't changed it since the last video, where it looks like the Fed will likely leave interest rates unchanged, and we don't really have a timeline for when that might change, because this idea of inflation coming down to 2%, that's been more stubborn or sticky, and so the Fed is having to rethink what they're going to do with all of that. The dollar was up slightly, and interest rates were also lower. We just ticked down just a little bit. We were at 4.49%, where we had been at 4.5% after Friday. We're still inverted with the yield curves. Sentiment, and I don't know what's going on with this. We should have seen sentiment really going up. And another sentiment chart that I'll show you shows things improving. But according to the CNN Money gauge that we look at, we were unchanged at 40, and so we're still negative. But this is where we're seeing a change. Our ADX is finally crossing over positive. The green line has crossed above the red line. Now we're still in a weakening trend. We're still below the moving average. So, but we're above 20. And now if we can get some follow through and really see some strength building to the upside, that will eventually turn the ADX back above its moving average. So we just want to keep an eye on that. With the update, our bias is positive, and in the last number of days, I've switched the momentum over to positive as well. We didn't have any economic reports. Some Isabel net charts says reasons to think that the bull has time left. If you look at all of these different times and where we're at as far as returns, and then what happens in the second year, this would just suggest that there's still more room to run. I showed a chart very similar to this for a Monday's video. And looking at buybacks, and I had an interesting question over the weekend. Do I have some kind of metric or some kind of a gauge of how much do buybacks actually impact stocks? I really don't. I look at the general trend, and then I look at the climate of the market. If any of you have some kind of a metric or something that you use to see what kind of an impact buybacks do have on stocks, because it tries to help their earnings per share, and they're buying it, so that pushes it up, and then there's fewer shares on the market. I haven't ever seen a study, but I haven't really looked for any kind of a study like that either. So if any of you come across something like that, please let me know. What we have in green, this is just the weekly amount of money that's going in for announced buybacks. And then they do a 3-month sum to kind of give us an idea. And that's the blue line. And this is going up. And that is typically positive for the market. And this is usually as far as I go with my analysis with this. If we're going up, that tends to be more positive. If we're going down, that tends to be more negative. Then looking at regional banks, the contrarian hard landing trade, where we're just seeing that regional banks are really underperforming, especially when you compare them with large banks. And this is still one of those unfinished scenarios that we've been keeping an eye on. And I have some more information later to show you about this. But the regional banks are not doing very well. And there's all kinds of theories. Some are conspiracy theories, some are actual fact-based theories. Are we going to get to a point where the U.S. only has a few very large banks? Are regional banks and local banks, are they going to start going away? We don't know, but there's debate going back and forth about that and the ramifications of what that could mean. And then mega cap growth and tech positioning, where we had been getting above this purple line, we were getting rather extreme. This is taking into account the recent decline that we've seen. So folks are getting they dropped down. And this could end up being positive because they're no longer giving an extreme positive reading. And then quarterly S&P 500 earnings per share. This is where we're at right now, and this is still kind of an estimate as earnings are being released. They see it going up going forward, and that justifies higher stock prices. Then some charts that I found, this also ties into the bank thing. It says a third of office mortgages packed into bonds are at risk of default. And this could really bleed over into some kind of a crisis at some point. Now, some people that I respect and pay attention to are really concerned about this. Other people say, no, this is a good old boys club. They're going to find a way to work this out. If anybody gets screwed, it'll be the average person. It's not going to be each other necessarily. So according to this, in Chicago is one of those areas that has a lot of risky loans right now. So we just want to keep an eye on this as well, because a large part of the plan for 2024 with the banks was that the Fed was going to be cutting rates. And they have these bonds and they have loans and they have different things that are going to be maturing that could really have an impact on them, where they had planned on interest rates being lower than where they're at right now. So that's why we just keep an eye on all of this. And sell in May strategy has faded in the past decade. And this is somewhat true. When we look at historical charts and charts that I'll be showing you later on with seasonality, yeah, May ends up being weaker. But over the last 10 years, it's actually performed a lot better with an average return of about 4% over the last decade. And then this kind of confirms more what I was talking about over the weekend in the weekly videos, and that the, we just parked right at the 50-day moving average for the S&P. Well, that wasn't the only index. And this tweet from Bespoke, I don't know if that's saying it the right way. I follow them on Twitter. It says every US index ETF in our trend analyzer screen finished the week within 1% of their 50-day moving averages. And you can see the whole list here, with the S&P, the SPY being one of them. And that's why I really I dismiss the criticism that people make of technical analysis. They think it's just voodoo and hocus pocus, and you're just watching a bunch of lines. And it can be that, believe it or not. But when you use it in a more systematic approach and you're seeing how different indexes and markets are interacting with each other, it can be very insightful. The best thing I've found, and for all of these to come together at the same time across the whole market, that's not happenstance. There's some rhythm, there's some mechanisms that are in place to make these things happen, and that's why we follow them so closely. And looking at the economic surprise index, where it has been coming down, and a large part of that was probably Friday's employment situation report, where this had been going up, and that was causing some concern, more of an inflationary environment. If this can continue to come down, where we're getting economic reports that are weaker than expected, because we're still in that frame where good news is bad news and bad news is good news. Now, at some point that might shift, but that's kind of where we're at right now. And this would help put the market more at ease if this, for right now anyway, was to continue to drop. Here's the cycles. Not sure where we're at. Maybe we're in the upward part of this as we start to come into more of the month of May now. Here's our intraday chart. We did have a gap higher open. We opened right at R1, quickly went up to R2. It acted as overhead resistance for a while, and then we actually broke above that. Now, just so you know, I calculated R3. That's at 4,200, and we're still roughly 20 points away from that. So that's why I didn't put this on the chart. But I was prepared just in case we did really start to move up, but we didn't get there. Intraday, also pretty much looking solid across the board. We opened with the futures in the Sunday afternoon session, and then Europe ended up being strong. Just saw things drifting higher, drifted higher in the daily session, and we're up. Well, we're pretty much flat right now, but we saw a real strong close going into the cash session. We are seeing an improvement here with growth versus value. The blue line's on top and advancing, and even though the red line's going up, it's underperforming right now. Intraday, the S&P growth to value ratio also showing some improvement. Could get even stronger, but the fact that this is going up is encouraging. Our end of day charts, growth was up quite a bit more than value for the large caps. It was up more for the mid caps and a little bit closer, but still up more for the small caps. So we're seeing a bit of a bounce with our small cap growth to value ratio, but still we need to see more follow through here. Also bouncing, but we're still under the 200-day moving average with mid cap growth to value, but showing some slight improvement there. S&P growth to value also did bounce up, but it would be nice if this really showed some more conviction if we kept going up from here. And our growth to value ETFs that we follow, we're just starting to come up to the top end of the rainbow. So after bottoming at the 250 period moving average, we've been bouncing up since then. If we can get above this, that will make things look even more positive. We saw a bit of a bounce with discretionary to staples, bouncing off its 200-day moving average with the ratio. Large cap growth. This was camped out right at its 50-day moving average, was able to break above that. This is one of the areas that broke above the 50-day moving average, and that's a real sign of improvement there. The Wilshire was able to get above its 50-day moving average. And then looking at our trend, we are seeing the green line crossing above the red line. So we have now turned positive. The ADX is still declining as it figures out because it's shifting from being negative back over to positive. We eventually want to see the ADX turn and go back up and cross above its moving average and see the green line continue to go up. Then short term, still declining. In fact, we're getting really close to 20 right now as the ADX is shifting from negative back over to positive, but this is turning positive as well. We did see a decrease in volume where it had been above average lately. And then sentiment, this is a new look at a chart that we typically look at where the gauge that we follow from CNN Money, we're over here, in the 40 range. We're here At this point, we're at 60.74. They're right between neutral and actually looking more positive. But this is a composite. This takes a lot of different things and puts them together. And then looking at the insider transaction ratio, coming back up, but we're still more in a neutral area. And so then I started following a new ETF, which I'll include whenever we have this insider. And these are legal insider transactions as opposed to the illegal kind. We'll just follow this ETF. It's starting to go back up, but it has not crossed above its 50-day moving average yet. Don't have the latest reading from Investors Intelligence. That'll come out in a few days. And I don't know why this is blank. It was blank before. I went back and checked, and I don't know what's going on there. There was a chart there before. The Ulcer Index is continuing to drop below its moving average. We're also not really changing all that much with the VIX, with the line chart, but we had a little bit, well, we closed near the bottom, but for an up day like we saw, you would think that we would see the VIX decline more than it is. And it could possibly be due to this. This is the VIX of the VIX. And I pointed this out over the weekend. This can be a little bit concerning because the VIX of the VIX is giving us very, very low readings. And that might be why the VIX is slowing down a little bit. And the momentum of the VIX continues to be down as stocks have been going up. The equity put call ratio ticked up just a little bit on the daily chart, and we're still going up on the 5 period. So that's still a bit of a warning sign, but this just means there's some hedging going on here. The volatility risk premium just continues to drop, showing that there's not a lot of volatility as measured by this indicator. We did decline with this fear gauge, and we're also declining with our other fear gauge. Our advanced decline line studies were showing an improvement with the advanced decline line based on price and volume. This is more the positive area that I've been latching on to, and it's turning even a little bit more positive. We're seeing an expansion of the new highs and not really an expansion of any new lows. So our 5 period and our 10 period moving averages are going up. We are positive with the advanced decline ratio. We're just getting a little bit above the moving average with accumulation distribution, where we had been pretty much on the moving average after Friday. Chicken money flows now turned positive. We're seeing a little teeny tiny green blip right now. And the Chaikin oscillator has crossed above zero and has now turned positive. The cumulative NYSE advanced decline line showing an improvement with the update. We're also seeing a nice little bounce here with our regular NYSE advanced decline line. This other advanced decline line is also showing an improvement. And we're actually coming back to this previous high where based on the S&P. Now, this is NYSE, where we haven't come back to the previous high yet based on the S&P 500. So this could end up being more positive. This could suggest that volume is actually leading price, even though we were below average volume in the total. The common stock advanced decline line, based on price, we are showing an improvement and showing a little bit more strength here when we look at this based on volume. We're still looking positive with the NYSE new highs minus the new lows. We're above zero and climbing. And here's our advanced decline line, the cumulative calculation for the S&P, breaking out, but not back to previous highs yet based on price, showing a little bit more strength here based on volume. We are seeing an improvement here with our advanced decline line studies with the NYSE common stock, the S&P mid caps, and the small caps. Short term, we did get above that 50-day moving average. We have some other pivot points above current price for right now and some round numbers that the market may decide to deal with. And the rate of change going back just from Friday to today, actually, if you measure from Thursday to Friday, it was pretty extreme. It declined a little bit, but it was still extreme from Friday to Monday, meaning that we've gone up pretty far, pretty fast. Again, that's not signaling so much of a reversal. It just means that we've gone quickly. And because we had the gap higher on Friday and then the continuation on Monday, the market might rest for a little bit. And we're going to be looking at that rest to see what develops, if anything, during that time. The Stochk RSI is still extreme positive. The Williams percent R is extreme. The CCI 14, and now we add to the list just barely the CCI 20. The 20-period moving averages, we are above both of them. We actually cleared them on Friday. So that was the more short term. We still have the 20-period below the 50-period moving average, though. That will turn things more positive if that could cross back above. But we're seeing where the blue line is starting to turn up compared to the red line. And we're also getting above with our double and triple exponential moving average based on 20 periods, and the lines are starting to turn up. We have now cleared the mini rainbow, so that's more positive as well. And we're going up with our 20, 50, and 200 period moving average studies. The force index is positive, but we're hitting this Keltner band pretty quickly here. So that might be a little extreme. I could have added that to the list, but didn't. With the stochastics, we're extreme positive in the short term, getting extreme in the intermediate term, coming up, but still below 50 with the longer term stochastics. And we're getting up into the +2 channel with our standard deviations chart. When we get to the high +2 area, or especially if we get into the +3, that's when we start to get extreme positive, according to this chart. Intermediate term, we've now turned back positive with the balance of power. It's crossing above the midpoint. We're still giving a kind of a brown candle here where it had been a lighter purple. So this is actually, it could be turning more positive, but these charts often redraw. So we'll see what colors they come up with next time. And we're above the midpoint and now getting up to the highest high value. We're actually a little bit above it. If we can stay above that, see the midpoint turn up and see the blue line turn back up, that will turn things more positive as well. The TTM squeeze just about ready to cross over above the midpoint and turn positive. The 50 period double and triple exponential moving average, we were able to get above both of them, and we're starting to slowly see the lines turn back up. Here's the 50 period. This was all the concern because we had come up to the 50 period before. That acted as resistance and we fell back. Now we've been able to break above it. So that's showing a real improvement. The ease of movement is starting to turn positive and crossing above the midpoint. The Arun's just not really doing much right now. We're looking positive with the S&P McClellan oscillator above zero and advancing. So we're going up with the summation index based on price and volume, which has been holding up a little better. It's just about ready to cross above the midpoint here and turn positive. And the NYSE McClellan oscillator also looking pretty solid right now. So we're turning up with the summation index for the NYSE based on price and volume. The Swenlin trading oscillator, this has been a more positive area we were latching onto. It's continuing to be positive right now, both based on price and volume. And we're showing some improvement, but in the process of potentially turning more positive with our oscillators. We're turning up with the PMO. We've already crossed based on price and volume when we break them out. And the studies of the stocks in the S&P measuring using the PMO, we are going up with the stocks that are rising. The buy signals are improving, and we're starting to turn back up with the PMOs that are above zero. A lot of this, because we had a pullback, a lot of this improvement has been taking place with the momentum oscillators below zero. So that's why this is turning up, and we're not really seeing an advance. If they can cross above zero, then we would see this indicator really continue to go up. We are positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. The slope oscillator is showing improvement. And you can see this is where the improvement took place. It was negative. And now it won't actually turn positive until we cross above zero. But we can look at this as positive now because it's moving up and above its moving average. The MACD showing a lot of improvement there. So with our oscillators in the short term, turning back to positive. We're turning up in the intermediate term. Little bit of a lag here with the PMO starting to turn back up with the tricks, and we're crossing above the moving average with the KST. So we're seeing some positive confirmation within our oscillators, but not complete uniformity, at least yet. And here's our moving average spaghetti tree. We're still below with the 20 period moving average above the 50, but we're breaking out above all the moving averages right now. So this is showing some improvement. The bullish percent index is above 50 and advancing. Not a huge thrust up, but still it went up. And we're turning back up with the NYSE bullish percent index. We're seeing an improvement here with the NASDAQ 100 bullish percent index, but we're still below 50. But this is really showing some improvement. Now, some folks, they use a buy signal when we cross back above 30. So this has already turned positive to them. For me, my line is 50. When we're above 50, we're positive. Below 50, we're negative. The money flow is crossing above 50 and turning positive. Ultimate oscillator above 50 and positive. The vortex, the green line's crossing above the red line, so that's turning positive. We're going above 50 with the RSI 14 as well as the RSI 9. On balance volume is crossing back above the moving average. The 20-period moving average steady. We're above 50 and now advancing. And this is kind of a breakout that I found over the weekend. This looks at the SPY instead of the S&P index, and this measures using 70 to the upside and 10 to the downside based on a 20-period moving average study, where other times we got to an extreme negative reading, and then this is kind of like a zwag NYSE breadth thrust when we immediately shot up to a really high reading and then see what the market did after that. Well, this was a failed attempt that we saw here because we shot up, but then ended up, we saw one of these triggered and then it shot up, but then ended up coming back down. But at the same time, we saw a positive divergence where price made a lower low. Here with this indicator, we made a higher low. And then we'll look what happened after that. And then this is when we really started to skyrocket up. So we're seeing a lot of improvement here where we had an extreme negative reading. We haven't come up to this above 70 area yet. So we'll be keeping an eye on this. So I'm going to include this for now in our charts. And we're just barely getting back above 50 with the stocks above their 50-day moving average. So now this is starting to turn positive. We're turning up with the 100 and we're turning back up with the 200. The Copic curve is positive. The Sean trend meter is now going up into this slimy green area and turning more positive. The Ichimoku cloud, we're still at the very top part of this cloud. If we could break out above that, that would be more positive. The Pring bottom fisher, which seems to this point to have given us a pretty valid signal, that's still in force. And the mass index is not generated its full library of signals at this point. We cross above the red dash line. Now we're getting above the blue line. The signal will actually be triggered once we drop back down below the red dash line. And that usually means a change of trend. We don't know what that's going to be at this point. So we just watch this. And it doesn't mean this thing's always right, but it doesn't mean it's always wrong either. Our different charts. We're turning back positive with the Heiken Ashi. We're positive with the Kegi. The Renko finally woke up and it's turning positive. And the 3-line break is positive. And we saw some new X's drawn in here with the point and figure chart. No signal has been generated, but we had a lot of X's up, then some O's as we were going down. Some X's are being drawn back in now as we've been going back up. Long term, we're still above this R1 level. We closed above it on Friday. That made the weekly chart look more positive, and now we continue to be above that level. And we're above this extreme positive reading with the 150 and 200 period moving averages. Again, that could suggest good momentum. We're positive across the board with the Keller market model, and we're showing a bit of improvement in the short term with bonds based on price, but they're still negative in the intermediate and long term. The dollar is still in a short-term downtrend. No change with the decision point scorecard. Still negative in the short term, positive in the intermediate term, and mixed in the long term. Saw nothing but blue or green. A lot of good things happen in Monday's session. A lot of technical damage that had been done is being repaired now. My goodness, can I get the word right? The equal weight was up. It slightly underperformed the S&P itself, so we're seeing this ratio going back up slightly now. We did get above the 50-day moving average with the Dow, and it wasn't really strong. If you watched the deep dive video, the Dow's in last place right now as far as performance. It's doing okay, and it's above its 50-day moving average, but when you compare it to the other indexes, it hasn't been hanging in there as solid. The diamonds, though, continue to be positive with the Elder's Impulse system, and we've come right up to this R1 level. And this is something we've seen over the last few trading sessions. The NASDAQ is actually outperforming the NASDAQ 100, which, okay, you could say, well, great, that's wonderful. That means more broad market participation. But it's the NASDAQ 100 that has really given the leadership as we've been bouncing up out of those lows since October 2022. But we're right at an R1 level. Is that going to matter? The NASDAQ 100 is above its 50-day moving average and not up to its R1 level yet. But we're positive with the QQQs when looking at the Elder's Impulse system. We're turning back and looking positive with the momentum of the NASDAQ 100. It's above its moving average. It's still below zero, but the histogram has now turned positive. So we are really showing some improvement here. And the Qs are above all their plotted moving averages. The longer we can stay above that, the more we might see the blue line, which is the 50-period moving average. The 20-period moving average cross back above the 50-period moving average. Small caps, yeah, they're showing some strength, and they're if we turn into a more economic friendly environment, which that's the scenario that the market is trying to develop right now, even in the face of all kinds of facts suggesting otherwise, that could really benefit the small caps. But until then, we are just pretty much chopping around in a range. But we're still positive with the Elder's Impulse system when looking at the small caps. And we're above this resistance level. We got back above the 50-day moving average with the Russell 2000 small caps. And we're going up with the RSI. The momentum has turned back positive. The longer term trend is also positive. The mid caps got above their 50-day moving average and are showing some real improvement there. They are positive with the Elder's Impulse system. Apple spiked up above both of the moving averages, but it's still in a downtrend. It was actually down 0.91% in Monday's session. Tesla was up almost 2%, but still has a lot of damage to repair if we're going to get back to a positive trend. It's still in a downtrend. NVIDIA was up 3.77% and breaking out above its 50-day moving average. Microsoft is coming right up to its 50-period moving average. Meta, after gapping lower, clawing its way back, but still below its 50-day moving average, and it was up a little over 3%. Amazon is looking fairly good right now, up 3.4%, not setting an all-time high yet, but above its moving average. And Google actually was up 0.5% and still in a longer-term uptrend. The FANG index, which did break above and close a little further away from its 50-day moving average than some of the other things we were following, actually added to that. It was up 1.9%. The financial sector starting to break out above its 50-day moving average. The staples to tech ratio, that is continuing to go down, which would be more positive. It was causing us a concern if this staples were going to start to outperform tech. If this can keep going down, that will be more positive. And the dollar, it did go up just slightly after it had been declining. We were into the 106 range. After Friday, we got into the high 104s. We've climbed back into the 105s now. And the correlation between the S&P and the world index, still kind of strong in the short term and pretty much flat to slightly declining in the longer term. And we're breaking out above the moving average with our total US stock ETF. So that's, again, showing broad market participation. Looking at bonds, and I have a number of extra charts that I went through in the What to Watch video that I want to update because we'll be keeping an eye on those. We ticked down just slightly with the 10-year yield. We were up slightly with the 10-year based on price. These are some of the additional charts. This is the 3 to 7 year bonds against stocks. When this is going down, that means stocks are underperforming. Bonds are underperforming. We saw a spike up, and that's when we ran into trouble with with stocks. Now that this is starting to go back down, and if it can keep going down, that would give more support to stocks. 1 to 3 month T-bills, which is pretty much cash, compared to 3 to 7 year bonds, that had been going up as inflationary worries were going on. We continue to decline with that ratio. And I'm kind of bringing out a similar scenario with each one of these charts. This is the S&P 1500, the broad market measure. It's starting to come up out of the rainbow when compared to bonds. Another broad market measure also coming out above the rainbow when compared to bonds. And we're still declining with our 1 to 3 year versus our 3 to 7 year ratio. When this was going up, that's inflationary. When this is coming down, that could be more inflation friendly, if not actually deflationary. And the QQQs compared to bonds starting to break out above the rainbow. And we're still anticipating a soft landing. We're starting to come back up out of the rainbow when we compare the S&P to 3 to 7 year bonds this way. And we're coming down with this other ratio. We look at TIPS. Those are short-term inflation protected securities. They adjust for inflation. That had really been going up. It's still continuing to go down. And home construction, a very heavily interest rate sensitive area, starting to just barely peek its head out of the rainbow when compared to bonds. The Eurozone, we want to keep an eye on what's going on in Europe. We're seeing some improvement there when we compare it to American bonds. So this is also looking stronger. And then looking at our growth to value ratios, showing a little bit of an improvement with the Qs to S&P, still coming back down to the moving average with discretionary to the S&P. We are seeing an improvement when we compare large cap growth to large cap value. So with the large caps, we're seeing an improvement. They're stronger. A little bit of a tick up, but still below a declining moving average with the mid caps and coming back up to its moving average with the small caps. We're still looking better here with our 10-day average of the S&P 500 highs minus the lows. And we're looking positive with the 19-day exponential moving average of the advanced decline ratio based on price and volume. We're above zero with our 5-period moving average of the highs minus the lows taken across the broad market. This a little bit of a concern here. This had really been coming down, the S&P to utilities ratio. It ticked up, but we want to see this turn and go back up to give more support to the S&P. And the staples to S&P 500 ratio, when this is going down, that tends to give more support to the S&P. It had been really spiking up. Now it's continuing to go down. We did not get a ZWAG NYSE breadth thrust, but did we get close enough? Jason Gepfert from Sentiment Trader made a post. He said, no, we didn't get there, but maybe we got close enough to still be positive anyway. So just something to think about. And then Tom McClellan posted this chart because he has a little more updated data than apparently I have here, where it took us 13 days. And I'm not sure if he's counting calendar days or trading days here. According to me, this would be the 11th trading day, but it would be the 13th calendar day since this whole thing started. So we were a day late. And then here's some times when it took 11 days, took 13 days, 11 days, 14 days. And then we did have the two legitimate ZWAG breadth thrusts. And then you can just look. Sometimes this was really positive for the market. Sometimes it ended up being negative for the market. So that's why we don't use this all by itself necessarily. We want to use other charts to confirm what's going on. So what's our outlook for Tuesday? We're now positive and above the 50-day simple moving average. We're going to get consumer credit, not a real heavy economic report day. And we want to keep an eye on all the crazy things going on in the world. Then the big one's probably going to be Thursday with weekly jobless claims and existing claims, and then consumer sentiment on Friday. We will, really nothing in Tuesday's session that even is up on this chart here. Seasonality-wise, we are positive for the Dow, where we're neutral to positive with the S&P and NASDAQ. We see a little bit of positive seasonality with the green dashed line. This will be the 5th trading day of the month. Tuesday is kind of pretty much nil. I mean, it's sometimes positive, sometimes negative, but not a real conviction going on there. Trying to work our way back up to this average based on this Carson chart, trying to come back up to this average with the Stock Traders Almanac chart. And then this is something that I talked about over the weekend where folks were thinking we might mirror 1968. Well, that's the green line here, and we haven't even been close to that. I'm not sure why that was happening. The country was going through a lot of things very similar to what's happening now in the US with a lot of college protests and things like that. And so they're seeing if the stock market might mirror more what's going on, where according to Stock Traders Almanac, we're actually a little bit closer to what happened in 2012, where we did see some pullback in May, but then ended up going up after that. And then this Carson chart also is showing a little bit of a drift off as we go through May. And then I did get the latest report from Tom Bowley, where May tends to be mildly bullish, where you have staples that are not hot, where tech is hot. And we're in that window now, where we're coming out of that window. We're going into the negative part, where we might see some more weakness here. And then according to his research, from the 26th going in through the end of the month is when we see more positive reactions seasonally. So the warning signs, we're still going up with the equity put call ratio based on 5 periods. The bullish percent index. Now, depending on your context, you may have already switched positive on that thing because it came back above 30. My definition is when we go back above 50. The oscillators, we're seeing a real improvement there, but we're not seeing real uniformity yet. And then pretty short list on the negative side, where we have kind of a long list here on the positive side with the S&P and NYSE McClellan oscillators. the Swenlin Trading Oscillator, the Parabolic SAR, the Bullish Percent Index, the Ultimate Oscillator, Chaikin Money Flow, Chaikin Oscillator, Money Flow, Vortex, the Copic Curve, and the Momentum for the NASDAQ 100. These have all switched over to positive. And then the financial sector is positive. And I took away the ZWAG NYSE breadth thrust. So our conclusion, we are now positive and above the 50-period simple moving average. In the short term, we are already showing some extreme positive readings now. In the intermediate term, we've switched to pretty much positive across the board, and we continue to be positive in the long term. So thank you. I hope you have a really good day, and I will talk to you in the next video.